if you have been investing abroad, especially in regions like North Asia and China, you would have experienced a lot of ups and downs, especially in years 2022 when China equities was just down. Now, you've heard arguments, demographics is terminal, property market is a black hole, a lot of hidden debt, and there is a huge tariff war ongoing between China and the US. And it's really a very compelling story, sells millions of books. But as someone who is an investor, I don't like to trade stories. I trade on data. And the data is signaling something that the collapse narrative completely misses. I think the world is still very much fixated on all China. And in this video, I'm going to examine the hypothesis of a bull China, as well as some of the risks that an investor needs to look at before we put in money to work in this market. If you're reading headlines coming out of China, especially about the economic data, it doesn't look very compelling. There's a lot of talks of property market collapse, rising debt, cultures such as Tangping, which is lie flat, very high youth unemployment, and also a lot of municipal council debt. So all these are not really compelling for an investor to want to spend time and invest into China. But I think that's where there is a little bit of disconnect. I mean, if you look at data from Goldman Sachs, they forecast and 20% upside on the Morgan Stanley Composite Index for China in 2026. And it's really not just an opinion, it's actually driven by estimation of a 14% profit growth in certain specific sectors. And I think this is where we are witnessing the bifurcation, the old economy where, low-cost manufacturing, factories of the world, investment into properties, a lot of savings of Chinese actually trapped there, which is true, no denying it. But what we're also witnessing is a pivot and a change into the new economy where a lot of high-tech manufacturing is accelerating. Ironically, a lot of the low-end manufacturing is being moved out into places like Vietnam and Cambodia and also India. We're also witnessing an elevation of high-value economic activities within China, not just within the Shenzhen area, but how they segregate certain regions to be specialists in certain niche sectors. So even just for textile, even just for semicon, they've already kind of geographically bound certain areas to be certain specialist ecosystems. And that's what, a lot of outsiders, especially with not much boots on the ground in China, is actually not witnessing. The smart money is also following the earnings growth potential, and that's where there is a high likelihood of valuation re-rating, especially if you're seeing earnings growth or profit driven growth of at least double digit, two digit, let's say 12 to 15%. That's where a highly likelihood of a re-rating will actually happen. And what we're looking for is catalysts for 2030, not for catalysts for this year, not even for next year, but a slightly longer term time horizon. So one good catalyst for China's economy is actually the reframing of the demographics. Now the narrative is there is an aging population, and the China one-child policy has detrimental effect to the growth of the nation. But if we reframe it from a demographic decline as a death sentence, look at what they are doing to counter or pivot that, which is actually industrialization and also much more automation. Because the single greatest catalyst for replacing human labor is actually robotics, is actually AI. It's actually not just running out of workers, but actually replacing them with something even more efficient. So there's one group of proponents that say China will grow old before it gets rich, but they're ignoring the substitution effect. And really, China is aggressively replacing this in spades, labor with capital. Industrial robots, today, China has the largest install base of industrial robots anywhere around the world. And they were not even the pioneers. The pioneers were actually Japanese. And industrial robot outputs have risen by almost 29% year on year for the first months of 2025, and then 2026 we're witnessing that going even higher. And then what they're moving on now, rather than industrial robots and automation, is actually service robot production, and that has grew roughly about 20%. So China is targeting roughly about 70% self-sufficiency on high-end robotics. by 2030. Now, as an investor, you don't short China because they're running out of workers. Yes, the youth unemployment is high, but I think where low, menial, repetitive, tedious work, dirty, dangerous, is being replaced by robots. I mean, I wish Malaysia actually adopted all this, but that's story for another day. So, what you can long on or look at are companies that are helping pivot into this innovation. Companies that are helping build what we call dark factories. You don't even need to switch on the light. You don't need even to worry about worker welfare, human welfare, because these robots can work 24/7 as long as there's electricity, air, high pressure air or gases. You can operate 24/7. So, furthermore, the labor pool isn't empty. You're seeing a higher and higher qualification standard. You have so many PhD graduates out of China, from the prestigious universities, and these are helping urbanize, modernize, climb up the value ladder for what the Chinese economy really is, rather than just trying to grow the labor force. So that is, I think, the first big catalyst. So the second worry for China is this thing called the involution, which is price to the bottom, competition, dog eat dog kind of world. And I think that is what the Chinese government is really aware of. So they have come up with like a survival strategy, which is forcing consolidation into certain industries. And they do this with the hope that you can restore pricing power rather than thinning margins and race to the bottom. What will happen is it will be very similar to in Malaysia we have this thing called government-linked companies. It will create a little bit more state-owned, I mean not the old state-owned but the new state-owned powerhouses, national champions for EV, for green tech, for manufacturing at scale, and especially semiconductor, which is a very big agenda or focus of the Chinese government. So while there's a school of thought that says China has not really advanced in terms of efficiency, the data shows otherwise. I think in terms of medium tech manufacturing today, especially exports, as I mentioned earlier, they are growing up the value chain. It's higher and higher, right? And today they are the world's largest producer of EVs, batteries. I think no one else in the world, including Japan or the US or even Europe, can even match them in terms of battery technology, right? And you look at the outlook for 2026, while US is way ahead in terms of growing the hyperscalers, which is all for AI, China is not too far behind. And in terms of energy sufficiency, I think the Chinese, even though yes, a lot may argue they may not be super clean, there's still a lot of coal running or producing electricity, but they are much more sufficient comparatively to any country around the world. I mean, US is just screaming for more energy for their hyperscalers, but China has already planned ahead. What I think they are being limited by, ironically, is this tariffs and trade blockades to get more AI chips. So instead about worrying of the involution and cutthroat price wars, I think the Chinese government is slowly putting down its hand and trying to prevent that from happening. And also they realize that the Chinese must have tech sovereignty. That's something that the Western world has always been dominant upon. And I think being single entity top-down approach has its benefits in allowing national champions, national agendas to be prioritized rather than it being lost in a sea of just capitalist-driven initiatives. So I think that is the second biggest catalyst for investing in China. So I've shared the two catalysts that I think it's worth looking into the Chinese market, but now I'll share the other side of the coin, the risks that we should look at. I think for me personally, it's always been too much government intervention. And for those of you who are unaware, Ant Financial, part of the Alibaba group, tried to spin off and list itself. And then on the very last minute, it was actually cancelled. And that is, I think, a very clear example of government intervention where an outspoken leader can actually be silenced, can actually be contained by a very strong central government. I think that is one of the reasons why me personally, I've not put in a big chunk of investments into China because of strong government interventions. Other risks that we should look at is really the over reliance on export. I mean, as a trading nation, as the capital of manufacturing globally, I think the actual danger of not being able to market or not having a market for its exports is real. If you look at my most recent trips to China, there are parts where I witnessed rows and rows of EVs being in just large storage areas that cannot find a market. I mean, they've been trying to export to Latin America, to Europe, and now more recently more into Southeast Asia. But they also realize that these markets actually cannot consume that much. And I think that's where the real danger is. If the trade war continues for the US, and the US is a big consumer of Chinese goods, I think that's where China's growth in 2026 and beyond will be dependent on this net exports. So that's one of the key things that you should look at as an investor. The third is probably not just pushback from the US anymore. I think Europe and emerging markets are also erecting tariff barriers because they realize that the more exports China is trying to flood into their markets, their own local economies, their own SMEs, their own GLCs are actually suffering from this overcapacity from China. And now if the world closes the door to Chinese EVs, solar panels, I think all these new productive forces thesis will really just come to a halt because yes, you can produce it at very, very efficient cost, but where's the market? Where are you going to market it? Where are you going to sell it? And you're not going to realize the profits from it because while EVs have enjoyed Chinese government subsidies, they can produce it cheap and be super competitive compared to other automotive vehicles around the world. You only realize that profit unless you sell the product, and that's where the struggle, the risk really is. The next is really execution risk. So what do I mean by execution risk is that can the central government really force more and more, especially if you relate it to the involution theory before this, can the central government really force enterprises, state municipal councils to really contain debt, to really be more capital efficient, to really not just compete based on a price to the bottom and declining margins? That's something that, rather than using a stick, can they provide stimuluses that allow for this anti-involution kind of movement? That is what I mean by execution risk. Can the Chinese government on the macro level allow micro level kind of execution to happen? So yeah, I think this is where I would bundle all that risk as compared to the bull catalyst and hypothesis about investing into China. So the conclusion is this: if you were to invest or you have a global investment mandate, I think global asset allocation and exposure towards the second largest economy, you should not have a passive index kind of approach, but a little bit more specific, sector specific or industry value chain specific kind of mandate, because not all sectors, I mean, if you buy property in China, you are exposing yourself to a lot of that risk. If you're talking about consumer spend, only specific niches within the consumer staples, consumer discretionary is actually growing. If you talk about industrial, the old manufacturing, low volume, low margin kind of China, that's where it's not going to grow. But you shouldn't be overcrowding into AI as well, because I'm very sure there's very little margin of safety. There's very high valuations that you have to buy into. So you have to find that niche where there is a reasonable price, sector specific, that is maybe ignored temporarily, but still has very high earnings growth potential. That's where how I would play my Chinese investment allocation. Now, last but not least, if you think about the decoupling from China, now realizing that rather than just sell to the US, obviously they still want to sell to the US, but with all this trade war, with all these barriers being erected by President Trump, I think that decoupling and trying to export into more markets, they started early, One Belt, One Road, going to Africa, going more into Asia, going more into Latin America. I think that is seeing results in offsetting the demand only from the US. I think if you were to invest into China, it's really investing into the use it as a proxy for growth into all these emerging markets that they're putting money into. And if the Chinese central government stabilizes the property market, you're not just going to witness a L-shaped recovery, you're going to witness a V-shaped recovery because the valuation re-rating is going to come, and you're going to enjoy, upside of not just growth of the Chinese or the second largest economy in the world, but growth because they are exporting into all these emerging countries that will demand Chinese products and services. So there you have it. You cannot play this market as a broad-based ETF or broad-based fund. I think you really have to be surgical in targeting all those anti-evolution beneficiaries and AI infrastructure plays, and also hoping that the government will not do another end financial kind of action. I think the Chinese capitalists or Chinese owners of businesses are also more strategic in their statements today, and I think that's benefiting the economy and the capital markets at large. So looking forward to seeing you in the next video, and I'd like to hear your thoughts. If you have invested in China, what are your thoughts about it, and what has your experience? Will you still pursue now after going through all this, or do you get a clearer picture that after this video that says you have to be a little bit more surgical? Let's have a chat in the comment section. Looking forward to seeing you in the next video.